Welcome back to DC, a crypto investor. In today's episode, we're going to uncover the main reason why most crypto investors actually lose money. Did you know that over 90% of retail traders fail in the long run? But don't worry, by the end of this video, you'll understand exactly what mistakes to avoid and how to set yourself apart from the crowd. Let's start with the truth. Crypto is not a guaranteed money machine. The hype makes it sound easy, but the data shows the opposite. According to multiple studies, the majority of short-term traders lose money, not just in stocks, but especially in crypto, where volatility is extreme. Why? Because most investors don't have a plan. They chase pumps, they panic during dips, and they treat investing like gambling. Think about it. If everyone could just buy a coin, wait a week, and double their money, then no one would work a 9-to-5 job anymore. Clearly, that's not reality. The number one enemy of most investors is not Bitcoin, not Ethereum, not even the market itself. It's their emotions. When the market is pumping, greed takes over. People FOMO in, buying at the top because they don't want to miss out. And when the market crashes, fear kicks in. They panic sell, often right before the recovery. This emotional roller coaster is why most retail investors underperform. They buy high and sell low, the exact opposite of what successful investors do. It's a cycle that repeats itself, trapping inexperienced traders in a loop of poor decision-making and financial losses. Another key reason 90% of investors lose money is the lack of a clear, repeatable strategy. They don't ask basic questions. How much am I willing to invest every month? Which coins do I truly believe in long term? What's my exit plan? Without a strategy, decisions are random, and random investing is just gambling. It's like trying to navigate a ship without a compass or a map. You might get lucky and find land, but more often than not, you'll end up lost at sea. That's where dollar cost averaging DCA comes in. DCA helps remove emotions by investing a fixed amount at regular intervals. Instead of guessing the perfect entry point, you smooth out the volatility over time. This approach takes the pressure off trying to time the market perfectly and allows you to build your portfolio steadily and consistently. Another big trap: overtrading. Many beginners think they can time the market, making dozens of trades every week. But in reality, constant trading often means constant losses. Fees add up, stress builds up, and one bad trade can wipe out weeks of gains. It's like trying to catch every wave in the ocean. Not only is it exhausting, but it's also counterproductive. The most successful surfers know how to pick their waves carefully, and the same principle applies to investing. And then there's chasing shortcuts, hoping for the next 100x altcoin. Most of these coins disappear, leaving investors with worthless bags. It's the crypto equivalent of buying lottery tickets. Sure, someone might win big, but the vast majority end up losing their investment. Successful investors don't gamble on hype. They focus on proven assets like BTC and ETH, and they use strategies that have stood the test of time. They understand that sustainable wealth is built through patience and discipline, not through chasing the next big thing. Risk management is another area most people ignore. They put all their money into one coin, or they invest money they can't afford to lose. When the market drops, they're forced to sell out of fear. It's like putting all your eggs in one basket and then dropping that basket from a great height. The results are predictably disastrous. Smart investors do the opposite. They diversify wisely. They invest only what they can afford to lose, and they hold a long-term perspective. This approach allows them to weather market storms and capitalize on long-term trends rather than being shaken out by short-term volatility. So how do you avoid becoming part of the 90%? The answer is simple, but not easy. Control your emotions. Stick to a clear DCA strategy. Stop chasing pumps and random coins. Focus on long-term wealth building, not overnight profits. By doing this consistently, you place yourself in the top 10% of disciplined investors who actually succeed in crypto. It's about playing the long game, understanding that true wealth is built over time, not overnight. Controlling your emotions means developing the ability to stay calm when the market is in turmoil. It means resisting the urge to panic sell during crashes and avoiding the temptation to FOMO in during bull runs. This emotional discipline is what separates successful investors from the crowd. Sticking to a clear DCA strategy involves setting up a systematic investment plan. For example, you might decide to invest a fixed amount in Bitcoin and Ethereum every week, regardless of the price. This approach takes advantage of market volatility, allowing you to accumulate more coins when prices are low and fewer when prices are high. Stopping the chase for pumps and random coins is crucial. Instead of trying to catch every trending token, focus on building a core portfolio of established cryptocurrencies. Research thoroughly, understand the technology and use cases behind each project, and invest based on fundamentals rather than hype. Focusing on long-term wealth building means adopting a patient mindset. Understand that significant returns in crypto often come from holding quality assets through multiple market cycles. This approach allows you to benefit from compound growth and avoid the pitfalls of short-term trading. Remember, the crypto market is still young and volatile. There will be ups and downs, bull markets and bear markets. By maintaining a long-term perspective, you can view market dips as buying opportunities rather than reasons to panic. Education is also a key component of success in crypto investing. Stay informed about market trends, technological developments, and regulatory changes. But be critical of your sources. There is a lot of noise and misinformation in the crypto space. Seek out reputable data-driven analysis rather than relying on social media hype. Another important aspect is setting realistic expectations. Crypto can offer significant returns, but it's not a get-rich-quick scheme. Understand that sustainable wealth building takes time and that overnight success stories are the exception, not the rule. Risk management should be an integral part of your investment strategy. This means not only diversifying your crypto portfolio, but also ensuring that your crypto investments represent an appropriate portion of your overall financial portfolio. Never invest more in crypto than you can afford to lose. To summarize, most investors lose money because of emotions, lack of strategy, overtrading, and poor risk management. But you don't have to make those mistakes. If you want to build long-term wealth through crypto, remember, be disciplined, be patient, and always stick to your DCA plan. By following these principles, you're not just avoiding the common pitfalls that trap 90% of crypto investors. You're resetting yourself up for long-term success in one of the most exciting and potentially rewarding financial markets of our time. Thanks for watching today's episode. Don't forget to subscribe to DCA Crypto Investor for more professional step-by-step guides. Your journey to becoming a smart investor starts right here. Remember, in the world of crypto, knowledge is power, and discipline is the key to success. Stay informed, stay disciplined, and happy investing.